Good day, traders. Welcome to my YouTube channel. I really want to thank you for the great work you are doing. I really want to request you to subscribe to my channel, to like the videos that I upload, and to give comments because there are these comments that I use to make future videos. So in today's video, we are going to look at order flow. We really want to understand how to trade the markets using order flow. So if you are a price action trader, you really have to put in much of your attention to this video. So when we are trading order flow, we really have to look at basic things. The market has to be in a trend, an uptrend or a downtrend. When the market is moving sideways, we stay aside and we wait until the market breaks. So when we are trading order flow, we look at these three basic concepts: the ERO, which is the external range liquidity, the IRO, which is the internal range liquidity, and the DOL, which is the draw on liquidity. So the external range liquidity are the swing highs and swing lows in the markets, all the previous candle highs, all previous candle lows. The internal range liquidity refers to the fair value gaps left in the market when the market is moving, all the order blocks created as orders are created in the market. The draw on liquidity, this is our target. The next target we look at whenever we are trading in the market. So without wasting time, let us dive into the charts and we look at this in detail. So we clearly see that the market was moving to the downside, and later on it created a swing high which we expected it uh, to trade lower from in order to break this lower low. However, the market did not do so. It went higher. So upon moving higher, where did it go higher from? It came into this order block, tapped in and went higher. What did it do? It broke this swing high. So upon breaking this swing high, it had taken out the external range liquidity. So the market will not go higher forever. It has to come back into the range that it has left. And where did it come back to? So the market came back and retested this order block that it had left, which is the internal range liquidity, and it gave it support to go higher. It took out this high again. So upon taking this high, what did it do? It came back into the range. And what was it coming to do? It was coming to take out this fair value gap that it had left behind. So we clearly see when the market is taking higher highs in an uptrend, it is creating more order blocks or fair value gaps to come and retest for it to go higher. So what is our draw on liquidity in these three scenarios? So in the first place, when the market was trading higher, we really had no draw on liquidity, not until it came and retested this order block. So upon retesting the order block, it gave us a chance to have a draw on liquidity. Our first draw on liquidity was this swing high, which we saw as our first take profit area. It again moved higher and we had no specific draw on liquidity apart from this swing high on the left. So when price started trading lower into this order block, it gave us an opportunity to have a draw on liquidity that we could probably take our profits upon involving ourselves in the market. So if you took a buy here, you would offset your buys from this swing high, or you would break even from this swing high. We again see that the market moved higher. We had no specific target apart from this fair value gap on the left. So when the market started trading lower, we had our draw on liquidity marked. What did it do? So when price retested this fair value gap, it went a bit higher and did not break this high. So, however, it came and changed the trend by taking out this swing low that it had left behind. So we had a change in the market structure, which we always call the change of character. So when the market changed character, we also change our bias. And now we are trading to the downside until the bias is also changed. So at the moment in time, our bias was changed and we really had to look at opportunities of how to sell the market. So our first opportunity was here. Market came, broke this low, and what did we wait for as traders? Upon breaking the law, we had only one chance to look for the internal range liquidity. So our only internal range liquidity was this fair value gap that the market left behind. So we clearly see that it left a fair value gap which it came to retest in order to go lower. So what did it do? It broke another swing low. And at that moment in time, this became our draw on liquidity. So if we got involved on that fair value gap, on this fair value gap, this swing low would be used as our draw on liquidity as the market started trading lower. It would be used as our target, that is. So when price came and took out this swing low, it also gave us another opportunity to add in trades. It left also this fair value gap. So at that moment in time, price came back into the range, which is internal range liquidity, retested the fair value gap and went lower. And that gave us another draw on liquidity or our target. So the draw on liquidity, when we started trading lower, we had this target as our draw on liquidity or where we would offset our trades from. So it goes on and on again. So taking you back where we started from, price was trading lower and it had broken this swing low. I really want you to understand what order flow is. So price had taken out this swing low, which was our draw on liquidity when we were trading lower, and price started moving higher. So our ultimate draw on liquidity, which is the internal range liquidity, was this fair value gap, which price came retested perfectly for it to have this move that moved to the downside. So we clearly see that price is taking lows or highs and seeking for internal range liquidity in order to move in its intended direction. So I want to show you an example of the trade that I took today on the Euro USD, which played out perfectly using this concept that I have just given you. Price was moving higher. It took out the external range liquidity and started seeking for internal range liquidity. Let me get off this such that we can see the market clearly. So when it broke this external range liquidity, this gave me an indicator that price would probably come back to retest the internal range liquidity. So I started eyeing because I also saw another indicator which was a fair value gap that was left behind. So these confluences proved to me, or they gave me an indicator that price would come back to retest this fair value gap for it to go higher. So what did I do? I had to mark this level and I put an order at the 50% level of the fair value gap that was left behind on the 1 hour time frame. I put an order and I targeted 3R. So price came back, retested the 50% level of the order block and of the fair value gap and went higher. And we had a perfect win or a perfect take profit. So this moment in time, we had our draw on liquidity on this swing high, which it exceeded, and went straight away into our take profit area. So that is it. That is how you can look at order flow. That is how you can improve on your price action trading concepts. You really have to make it easy. You really have to look at the market in the simplest way that you can understand. So I wish you the best of the trading week. May the markets go with you.